All right, today we are cracking open the investor's case file on Dynatrace. It's a $14 billion company that, really sits at the heart of our digital world. We're going to break down what they do, how they make money, and of course, the big arguments for and against them as a business. So let's get into it.
So here's the game plan for today. First, we're going to tackle what observability even means. Then we'll dig into their business model, size up the competition, and finally, weigh the bull case against the bear case to get to the one question every investor is asking right now.
Okay, let's kick things off with a problem we have all felt. You're trying to use an app, a website, and it just stops working. Now, for you and me, that's annoying. For a business, that's a full-blown crisis. And in the crazy complex digital world we live in, figuring out why things break is a huge, huge challenge.
Well, the simple answer is complexity. Think about it. Companies these days aren't running just one little program. They're running these gigantic, interconnected ecosystems that are spread across who knows how many clouds with millions and millions of lines of code. It's gotten way too big for any human to manage by hand. So when something goes wrong, trying to find the cause is like trying to find one bad wire in an entire city's power grid. It's almost impossible. And this is exactly where Dynatrace comes into the picture. Their whole platform provides something called observability. The best way to think of it is like a team of AI-powered doctors for a company's entire digital operation. They don't just tell you, hey, the patient is sick. No, they analyze unbelievable amounts of data in real time to tell you exactly what's wrong, why it's wrong, and how to fix it. They basically turn that chaos into a manageable asset.
So, you've got this incredibly powerful technology, but how you turn that into a powerful business? Well, for Dynatrace, the answer is all about a strategy they call land and expand.
$450,000. Get a load of that number. According to Morningstar, that's the average annual recurring revenue Dynatrace gets from a single customer. It just goes to show you, they're not playing in the small leagues. They are building massive, high-value relationships, and that number keeps growing, which really proves their strategy is working. And see, Dynatrace isn't just chasing after every single business out there. Nope, they are laser-focused on the big fish, the top 15,000 global companies. And why? Because these are the places with the most complex, the most mission-critical IT setups, which means they're the ones who need a platform like this the most.
So this strategy plays out in three pretty clear steps. First, they land inside a company, usually by solving one very specific, very painful problem. Then their platform proves how valuable it is, so the client starts to expand how they use it, adding on more and more modules. This makes the Dynatrace platform incredibly sticky. Once a company builds its whole operation around it, switching to a competitor becomes a massive headache and a huge risk.
Now, of course, a market this valuable is going to attract a fight. Dynatrace is not off in its own little world. They are fighting on a very crowded and very competitive battlefield.
You have to understand, this market is in constant motion. New tech, new customer demands, it means the goalposts are always shifting. This isn't just about having a great product today, it's about being able to innovate fast enough to stay ahead of some really, really big players tomorrow.
And when you put the players side by side, you can really see just how intense this is. Dynatrace has a solid $14 billion market cap, but that's just dwarfed by its rival Datadog, which is sitting at over $47 billion. And just look at that price-to-sales ratio. Investors are willing to pay way more for Datadog. This whole valuation gap, with Morningstar calling both Dynatrace and Elastic undervalued, really sets the stage perfectly for the bull versus bear debate.
Okay, so with all that pressure, why would an investor be bullish on Dynatrace? Let's break down the optimistic take on all this.
The bull case really stands on three main pillars. First, the entire market is just growing like crazy. As more companies go digital, the need for this stuff just grows with them. Second, Dynatrace is adding new products, which gives their sales team more doors to knock on inside a company. And third, even with all their success, they've only captured a tiny piece of their target market, which means there's a huge runway for more growth.
And hey, that optimism, it really shows up in the numbers. Their annual recurring revenue, which is the absolute lifeblood of a software company, isn't just growing, it's growing consistently and fast. Going from $1.25 billion to over $1.7 billion in just a couple of years, that is exactly the kind of momentum that gets investors really excited.
But it's not all clear skies. Let's flip the coin and look at the bear case. The arguments that give investors a little bit of heartburn.
The bear case points to three major headwinds. First, like we said, the competition is just brutal, with giants like Datadog and Splunk breathing down their necks. Second, staying on top in this space is super expensive. Dynatrace has to pour a ton of cash into research and sales, and that puts a squeeze on their profit margins. And finally, those big, juicy enterprise deals, well, they often come with really long, complex, and expensive sales cycles.
And look, this isn't just some analyst's opinion. This warning comes directly from Dynatrace in their own annual report to investors. I mean, when a company tells you flat out that competition is a primary risk to its growth, you've got to take that seriously. It's a statement you just can't ignore.
So all of this brings us to the final verdict. When you put the bull case and the bear case right next to each other, it really all boils down to one crucial $14 billion question.
Can this company's powerful tech and its proven land and expand model keep winning, even with all this intense pressure from rivals with really deep pockets? Is its current valuation a bargain for a future leader, or is it just a fair price for a company that's in for a brutal fight? That is the fundamental tension here, and the answer is going to determine everything for Dynatrace and its investors.